All right, so the rates have been off. We got not too much action right now. It was a 75 basis point hike. We're at 150 to 175 right now. The market's kind of reacting to it, but they're waiting for Federal Reserve Chair Jerome Powell to come out and speak. Right now, oh, here we go. We're getting some news. We're seeing the aftermath. It's been out for about let's see, 3 minutes now. So things are just getting going. We haven't really seen much yet. Let's see. Fed officials see unemployment at 3.7% at the end of 2022 and 3.9% for 2023. Says strongly committed to bring inflation down back to 2%. So that's low unemployment, but that's kind of where we are. I think we're at 3.6 right now. So basically, they're saying over the next year, we're not going to see a whole lot of movement, maybe a little bit of an uptick in the unemployment numbers. That's kind of what we thought. So that's nothing surprising right there. See, Fed signals faster pace of rate increases. Yes, that was what I was going. All right, when I was coming over here today, getting ready to go, I was thinking the pressure, even from just a few days ago, is on a lot more. See, I thought this weekend that the pressure was really high and that, and that rate hikes were going to be faster paced than expected. But oh, here we go. We're dumping a little bit. This is what I've been waiting for. All right, I want to see this a little bit more, but this is nothing. We have to wait till he talks. So hopefully this downtrend can hold for a while because usually these kind of bounce around a little bit. They're really volatile right when it comes out and then it sort of settles because we have a good 25 minutes or so until Jerome Powell comes out and actually says what they're thinking. Right now they just released the rates and they released their little sheet here that says everything. We have to hear it from the dude, right? A lot of this has to do with psychology. So we're going to have to hear it from the dude. Dad has to come out and say everything's okay, basically. That's kind of what we're waiting for on Jerome Powell here. So what else we got? Federal officials see inflation of 5.2% at the end of 2022, 2.6 for 2023. Yeah, well, I mean that's kind of what we were thinking. It's gone up in the estimates. It's not as terrible as I was thinking it might be, but that's still not great. 5% inflation is well above their goal of 2. And if you have to think if you think about it, for the last few years, inflation has been under 2%. They were actually doing everything they can to bring it up to 2%. Because here's the thing about inflation that a lot of people don't understand. Inflation is actually a way, like, yes, it's a tax on people. It's kind of theft in some ways. Yes, absolutely. And it's a way to cover loans. It's a way to cover the debt. As time goes on and you accrue more debt, having inflation increase the amount of money that comes to you is beneficial to pay back that debt. So any loan you get will be easier to pay back as time goes on if the loan stays the same size, right? If you borrow $100, it's easier to pay that $100 back later. And that's what the United States government, that's basically what all governments around the world that engage in this system are thinking. They all have debt. We all have debt. There's massive, massive debt. Oh, look at this. We got a nice dump going on right now. So going down a little bit is kind of what I was expecting. I'm waiting. I don't know if we're going to get a bounce. See, that's what I normally play. I normally play a bounce on these things. But right now, it doesn't seem like that's what's going on. It might. We'll have to see later. It depends upon what Jerome Powell said. But at the same time, we just have to be careful. So I might be sitting out today. I might not be doing anything at all. So how much time do we have left until so let's see, we got about 23 minutes. So we're still sitting here just watching the news, watching the reaction. This is normal. We want to kind of soak this in and figure out if we're going to make some moves based on this whole thing. Right now, I'm not really thinking much, but that could change very, very easily. So let's see. Look at that. It's bouncing back up right there. In fact, I might want to change this to a shorter time frame. I'm going to go ahead and close the news for now. And I'm going to come over here to the 10-minute block. I'm going to switch this to I like it. Well, I guess I'll do 5-day, 5-minute. That should be good. Zoom in a little bit here. So okay, so that gives you a little bit better of a picture of what's going on. So we had this little pump going up into it, 10:55, and boom, here we go, 11 o'clock. You can see where the volatility starts. So we're down a bit, not extremely though. I mean, think about it. We were in the high 370s. We're in the mid 370s now. That's not really enough for me to do anything with. I mean, if you were using large amounts of money, you could have made a quick scalp on these shorts, but I don't really do scalps. Very often at all. I mean, the only scalp I really did recently was the last Fed meeting when they had that little pop. That was a nice little scalp. I got out of it same day, but I don't know if I want to take a chance again. However, here is the one thing. So for months I've been saying that if the Fed slams rates up higher than 50 basis points, then we might have some serious volatility in the market. We might have a panic. But here's the thing that's changed since then. The average consensus is that they should do that or more. So I don't think the market's going to panic quite as much for this 75 basis point hike right here, because this is what people want. I mean, this is what needs to happen in order to stamp down inflation quickly, because we have a serious problem on our hands. Inflation is one of those things that it's exponential. When it starts to get out of control, it gets worse and worse, faster and faster. So in the early stages, you kind of have some leeway. You know, that's it. I think that's why the Fed was acting slowly at first. They thought, okay, if we wait this out, maybe inflation will kind of come down on its own. We won't have to do much. Or if we let some of the supply problems clear themselves out before we adjust rates, then maybe we don't have to adjust as high, and we can have a quote soft landing, which is what they're trying to do, meaning they just want to bring prices down without hurting the labor market and people too much. So that's kind of the thought. It's like how can we hurt people the least, right? That's where their head is right now. Not how can we save things, but how can we hurt people the least? Because we're at the point where that needs to happen. So look at this. We're getting a little bit of a bounce here. We got a green candle. It's going back to red. But this is why I say I don't like to trade this part of the announcement, because there is a little volatility right away. But usually within like 10, 15 minutes, this kind of clears up. And then it finds its little spot that it hangs out until Jerome Powell starts talking, in which case, we may be able to make some kind of an entry here, but I don't think I'm going to. I'm going to zoom back out a little bit so I can see that better. In fact, let me zoom in on this one so we can see the picture. So this is kind of where we're at. Look at that. We're really hanging out. These are daily candles. So this would be, let's see, Monday and Tuesday right here. We really haven't moved that much, and that's pretty much what I was expecting. A lot of times when the Fed is going to announce something, people kind of sit on the sidelines for a little bit. There's a little volatility because certain people want to adjust their positions. I was doing that well before this because I didn't want to be caught up in anything weird, just in case there was weird panics or weird pops, which last time there was kind of a strange pop right before the Fed announcement. So you never really know with that. But if you think about it, it's like there's fight, flight, or freeze, right? In the wild, like if a predator comes at you, you freeze for a second and you either react or you don't react. That's kind of what people are doing right now. They're all freezing, right? Some people are reacting, but most of the market is just kind of sitting there and not moving and seeing what the Fed does, because the Fed is the predator right now, and we're all in its sights. We're the prey. So we got to see what the Fed does to either help us or pounce on us. I don't necessarily think they're going to pounce. I think they're going to try to keep this as non-volatile as possible. I do think that there's going to be some volatility, but they're going to do their best to not enhance it, basically. So let me see right here. I got to get the news back up real quick. Let's see what we got going. Yeah, it's a lot of the same stuff. So futures moving lower following a Fed decision, now around 37.54 level. Yeah, well, I mean, the SPY is a proxy for that. We're basically, I like the SPY during market hours because it's just a little easier and more people trade. Well, I don't know about more people trade it, but um, a wider variety of people can trade the SPY, and it's very popular. And the news goes more towards the SPY's ticker symbol than it does towards the futures, any of the futures that I look at. So I usually use that as a proxy. When market hours are not on, then I'll use the futures, just because that is 24/7 until the weekend, which I think that it stops on Friday and restarts on Sunday. But right now we're just kind of seeing the SPY do its thing. So I got to go over to my other screen here, make some adjustments. Just kind of getting going right now.
This one is
Oh,
called
geez.
Circle.
Twitch always has something going on the main page.
Twitch always has something going on the.
Ooh, there, I gotta close that out. Don't want to, don't really need myself going there. I was trying to get chat open because I got these windows all scrunched up, but it doesn't look like I'm getting the chat here. So yeah, we're getting a little bit of volatility. Let's see, how much time do we have left until it's 11:13. So we've got, what, 17 minutes until Powell comes out. Once Powell comes out, I'm going to put him up on the screen. We're going to listen to him. What we're listening for is their plan for the future now. All right, we already know the rate hikes, the 75 basis point hike. We're at 150 to 175 now, but what we want to find out is what they're doing in the future, because the next rate hike was supposed to be a 50, but now we want to find out, is the next one going to be a 75? Is it going to be 50, or is it going to be 100? Because it could also be 100. I think what's going to happen next month, hopefully the data will come out before the meeting, and if inflation is still terrible, then they're going to hammer it a lot harder than they are right now. But if it's not, or if it looks like it's kind of peaked a little bit, then they might be a little bit less aggressive. They might be more dovish. We'll have to see what happens there. So right now, we're kind of hanging down at this, let's see, 37.50 level. It's been there for a little bit. These are 5-minute candles, so we got about, between 5 and 10 minutes of time where it's just sort of bouncing in this area. But look at that, it's not that far below the range. I mean, this whole day was just bouncing in this, like, 375 to 3, so $5 range basically. It really wasn't wasn't doing much at all. I guess it would have been a $50 on the actual index, but right now on the SPY, it's just a $5 move. See, we're breaking down a little bit. See, this is kind of what happens. It's not really anything to worry too much about. I'm basically just killing time until Jerome Powell comes out. But we just got to have a plan in place. So my plan is mostly to sit on the sidelines here. I don't know if I'm actually going to do anything. I've been racking my brain trying to think of a trade. I really want to find a trade, but I just, if I don't feel good about it, I'm not going to do it. Okay, I got chat going. Good. Didn't really miss anything. Awesome. So I think I'm just going to be sitting here for most of it, but if I see an opportunity, I might grab it. A lot of times, what I do is go for the indexes because the indexes are the easier ones to predict. Individual stocks will pop a little bit more. You can make a little bit more money in those, but the individual ETFs are usually a little bit easier because they'll move with the broad market, and they'll have higher volume and tighter spreads. See, that's what I really like about the indexes is they have really tight spreads. Especially, I mean, I'm playing options most of the time, so spreads to me are extremely important. If I can get into a trade and get out of it for like a penny or two difference, that's wonderful. I really like to have that ability because a lot of times these spreads are 50 cents wide, dollar wide. When you're buying multiple contracts or expensive stuff, that can really get you. Because I mean, if it's a dollar wide spread and you buy something, you're automatically down $100 just on that buy if you wanted to get out of the position right away. Because even you probably won't get out at the mid price unless it's really popping. And of course, if it is, then there's going to be a tighter spread because more people want it. So I'm mostly avoiding those. Probably going to go for the ETFs. Probably not going to do much of anything. Oh, look at this. Now we're bouncing back up to that VWAP level around 377. So VWAP stands for volume weighted average price. It's a way to measure what the average price theoretically should be based on average trading with volume. So if you took all the price action from these candles and you added them up to an average and you weighted that against the volume at which they came in, you'd have VWAP. And that's just kind of a way for money managers and anybody in general to get an idea of where the stock is for the day. You'll notice that right now when it comes up and it's hitting VWAP, this is normal right here. A lot of times once it gets to that point, it's going to test it for a little bit before it either moves past it or gets rejected. So we're probably going to see this pump up and down below it because everybody's chart is different too. Like if you just put the average VWAP on from your generic, Thinkorswim program like I'm using right now, it's probably going to be a 2-day average. I usually try to set mine to more like a week or two so that I get a more long-term average for the VWAP because it's easier to trade something when you have a broader range of data to go against. Like if you're going with a 2-day average and the stock has moved quite a bit in 2 days, that VWAP isn't going to mean as much as it will if you have it going back for a couple of weeks or even a couple of months. Which on my long-term charts, I will put it up for a couple of months. So let's see how we're doing here. We are 11:18. We got 12 minutes left. We're still just watching the SPY. Over here, I got Bitcoin. Bitcoin's been hammered. It's at 20,000. I've been waiting for this. See, I was buying some a little earlier, like up here in was it 24,000 or something? I bought some in the high 20s and the mid 20s. I'm thinking about buying a little bit more down here because it's getting low. And depending upon what happens here, if Powell comes out and he's somewhat dovish, then I think it's going to pop and we have a good chance for a nice squeeze. So someone during the stream on Sunday said they were guaranteeing it was going to be a green week. I somewhat agree with that. I think there's a good possibility that we have a huge squeeze because even if things are bad enough and the weight of the market will eventually pull itself down over time, there's still a good chance for that pressure to be relieved to the upside because shorts are always more bearish than they need to be, right? Some shorts are good, they get in and out, they make their profits, but a lot of shorts don't. Right, a lot of shorts have a bunch of money. They're disgruntled longs, and they're just trying to get in because they think everything goes down. They bought into a position and it went down. It's always down. So they're really bearish on things like this when it comes up. They overextend their hand, and what happens? Boom, it explodes upwards, and they get a margin call, which means their broker is calling them and telling them they need to sell because the amount of margin, i.e., the money they're borrowing, is past its limit. Like you have to have so much collateral to cover the margin you have, and as stocks drop or as your position drops, your capital goes down. So they hit a point where they say, all right, you don't have enough capital to maintain the margin that we're giving you. You either need to add money or sell securities right now to cover your margin costs. So that's what happens when people squeeze. They're way overextended. They're using margin, so they're not even just using their own money. They get a margin call, which means they have to buy now because a lot of these people don't have extra money to throw in there. Or if they do, it's not enough to cover these huge short positions, especially if it's like a firm or something that's using millions and millions of dollars. So they'll get squeezed out. It'll cause the bulls to come in and buy, and the price goes up exponentially. That's basically what a short squeeze is. When you were hearing about that GameStop stuff last year, it was because people were super overextended and they had to buy shares to cover their short position, which of course drives the price up. You add more buyers, you take away the sellers. Right, the resistance goes down and boom, they can pop. And look at that. This is exactly what I was expecting right here for the numbers. This is like every single time the numbers come out, this exact pattern is what you see. You see this big dump, this big panic, huge candle for the first section that it came out. So this would be like the first 5 minutes. It was extremely volatile. It moved up a good, $6 actually, and down $6. But now it's kind of settling back to that midpoint around VWAP, which is where it probably should be. So this is why you don't really trade those. I mean, if you're good at scalping, you could have made a good little profit right here on these like when this third candle was coming up and it was going green, that was when I thought, okay, this is probably where we're gonna get our bounce. But I didn't trade anything because it's like, all right, I'm going from what 375 to 377. I don't want to risk money to try to scalp that little amount. Like I'm looking for a pop up $5-10 in the sky, right? Like I don't know if we go down to this bottom chart right here, if we can get back up to this, this other candle from I want to say that was like Friday, 390 or the high 380s. Like look, see here's a longer term VWAP right here, perfect example. So this line right here is VWAP over the long term. This one should be either weeks or months, and you can see how it's basically a straight line. That's because it has way more data to go on, whereas the one up here is only a 2-day, so it's going on yesterday's data and today's. And if you look at yesterday and today, there's a pretty big difference. It went down well, not really. It's about the same, huh? So yeah, low 370s went up to the high 370s, and it's kind of traded in that same range today. So here we go. Oh, we're going down again. Yeah, so this is kind of how it goes. It's just this up and down wave motion right here. It's basically what we saw earlier, the up and down, but it's accelerated because algos are going nuts right now. And then people are trying to combat it, and there's new traders that think this is where you get in and out. Like it's a rough mix right here. So I'm going to wait for the extreme volatility if possible, but probably won't end up doing anything at all, to be honest with you. I'm a little scared about this, but at the same time, I also think this could be more stable than I thought. Now that the market's expectations have come up or down, however you want to call it, to the point that the Fed is. Like the Fed was going to go 50 basis points just a week and a half ago. I mean, they were talking about everybody calm down, it's no big deal, until last week when things picked up and a lot of different organizations were saying, hey, we need more. And here's what really changed my mind. Monday and Tuesday, multiple large firms came out and predicted a 75 basis point hike. JP Morgan and Goldman Sachs were among those. And when Goldman Sachs is very good at guessing stuff like this. It's like, oh, maybe it's because they have people in high places that kind of know things. Yeah, I mean, a lot of these big organizations do. But for whatever reason, Goldman Sachs is a little bit more accurate than other banks most of the time. Not always. So when I saw them coming out with a 75 basis point hike and then JP Morgan right after that, I thought, all right, these are two of the biggest banks in the world. These people have way more information than I'll ever have, and they're predicting a 75 basis point hike. It's very likely that the Fed's going to come out and do that. Because the other part of the Fed is the Fed wants to listen to the market. I mean, their whole job is to stabilize prices. That's the reason the Fed was invented in the first place. I mean, there's all these, theories about it and there's, potential for abuse and control and stuff like that. But the main reason it was invented was to keep prices stable. So having an institution that can listen to the public or listen to the big players in the space and adapt to what they either need or want is helpful for stuff like this. So we really have to see what Powell's going to say. I'm really excited. I'm a little bit nervous here. 6 minutes left. We're getting close. Hopefully the stream's going to come in well because it was having problems a little bit ago. But see if we got any audio again or if it's still being weird. Okay, good. There we go. Got that jazz music going. Huh? Let's turn that down. All right. Man, the Fed slaps right now. Look at that. Let's get the cryptocurrencies up. All right, so Bitcoin still at 20K, 20.5. Ethereum's down to 1,000. Oh, that's brutal. Man, Ethereum was 1,900 not that long ago. I mean, I want to say like a couple of weeks ago or something like that. I really wasn't following it too much, so things have really dropped. Let's kind of go down the list a little bit. Solana, ooh, that's up a bit. Not very much. It's only up about 1%. Dogecoin, See, I got like tiny, this little account right here, I have tiny amounts of this stuff. I got like 0.005 Bitcoin, 0.1 Ethereum. Like, I don't really have a lot in this account. This is my trading account, but anywhere I can get a little bit of cryptocurrency, I'm gonna do it. That amounts to probably like $100 worth or something of each of these. It's really not much at all. But I'm going to be adding heavier in my other accounts for sure because I really want to get. If we drop, like, if we get a little squeeze and then we have a drop for the next month or so, oh my God, I'm going to be so happy. It's going to suck a little bit because I'm getting really tired of seeing my account down every day. You know, there'd be like one day out of the week that it's up, and then every other day is just down, 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 and that psychologically destroys you. It's not easy to deal with. Even though I know that I'm okay and I've got most of my cash sitting on the sidelines, so I'm not really worried about it. It still hurts to see everything move downwards day after day after day. So look at this, we're kind of settling down towards the bottom of this range. It's still, if you look at the whole day, it's kind of a downward trend. Like, you could draw a diagonal line going like this. So it's not really doing a whole lot. But if you look at it on the longer term chart, it's really not doing all that much. It's still within this range right here, which is not surprising to me. So my thought here is, if we get a pop, I'm looking for that long-term VWAP pop. So somewhere in the mid to high 380s, maybe 390. That would be if we get a good little squeeze going on. Let's see, how's the volume doing? Volume's dropping off on this, so we're kind of probably getting more towards the area that we're going to sit in. If you see, it's hard to see on here. In fact, let me bring it up a little bit. The volume average is right here. We haven't even hit that for this little candle, but it just started, so it's probably going to go over that. So we have had some volume, but you can see, like, right away, that first candle, it was highly volatile. There's a lot of volume, and then it's been decreasing ever since. That's kind of how it goes, though. Like, normally the volume comes in right away, and then everyone else comes in afterwards to trade on it. So if you really want to make the big move, you got to be in for that first one. But the problem with being in for that first one is you really don't know which direction it's going to go. So jumping in at any point is not really easy. I mean, I would have guessed that this would be the pattern that it displayed, but I wasn't going to play it just because, you know, it's not really worth it. In this market, I want to be much more convinced that I can make something before I actually make a trade. Oh, 2 minutes. Here we go. We're getting close. 2 minutes till Powell comes out. See, this is where it's at right here. Everybody's like thinking finance is boring, but it's not. This affects your entire life. I mean, even if you're not into trading or investing, but you still have a retirement account, or you have money in general, which is most people, it's good to know what's going on, to see if you can take advantage of that. Because even if you're using a small amount of money, it's still beneficial to know what's going on, because as time goes on, you're going to gain money and knowledge, and if you gain money and then try to get the knowledge, you're going to be behind everything, and you might make a lot more stupid decisions in the moment. So it's better to just learn while you can. Immerse yourself in everything. Even if you're not doing anything, just pay attention to the market and see what happens, so that later on when you do, you have some kind of an idea. So let me pull this back up here. Where's those cryptocurrencies? Oh, not that. I opened Brave browser on accident. See, I'm trying to transition over to Brave browser. Been using Opera mostly, but I like Brave browser because you can exchange basic attention tokens, a cryptocurrency, and actually make money as a creator without having to go through, like Twitch, for example. They have all these hoops you have to jump through to be able to be an affiliate or a partner and make money through them. So using something like Brave browser allows you to just get paid without having to do any of that. It's much more open, which is what I like about not only that, but the cryptocurrency space itself. So how are we doing here? Oh, 1 minute. We're getting close. Let me pull up. I got to see the exact time here. Oh, 20 seconds. Of course, he'll probably be out a little bit after that. They're not usually perfectly punctual. Although I bet the camera will start then, and we'll be able to see what's going on. So I'm mostly going to not talk during this. I might pop in here and there with some comments, but we want to see what happens with Jerome Powell. When they start doing questions, I might go over some stuff a little bit. If I make a trade, I'll let you know, but my plan right now is to kind of sit out and just see what happens. So at this point, we really don't know. Okay, it is 11:30, and here we go. All right, Powell's not out yet, but we have the camera going. This is exciting. The market's still going down a little bit. We're at 374, kind of hanging out down at that level. But right now, it's mostly just the back of people's heads. I'm getting excited. Oh, God, I got that feeling right now. I got that adrenaline rush. I mean, since I don't day trade that often, it's a little bit nerve-wracking for me to actually think like, oh, I might do this here. So we're going to be coming up with something in a bit. Go on, pal. See what I mean? They're usually a little bit late. Like, they start the camera and everybody's ready, but they're hanging out backstage, doing whatever they're doing. I don't know. Maybe Powell's back there, like, throwing back a couple of shots before he comes out. Oh, here he comes. J. Powell. All right, here we go.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage points and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March.
That's exactly what I was thinking.
0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value.
So no drop in 23 with the rates.
Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now.
Got that right.
Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
50 to 75. I got that
our
right on my chart.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh man, that was exactly what I was
hoping for. Thank you, Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50
getting
basis
aggressive
point
right
hikes
away?
in
Look
June
at this.
and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial
Go, buddy! Look at
markets have
that.
responded,
My calls are way up right now. This is
generally
great.
shown that they understand the path we're laying out. Of course, it remains data dependent, and so
Data dependent. There it is.
that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So
Could you just saying raise rates by 75? Ha ha, we're fucked.
we got the CPI data.
I don't know about that, man.
And also
75 is
some data
what we
on
wanted.
inflation expectations.
Definitely have some problems with inflation,
late last
but
week.
That's a nice.
And we thought
that's a nice
for a while,
inline
and we
cut
thought, well,
from
this
what
is the
market was
appropriate thing
thinking
to do.
right before
So
it
then the
happened.
question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Big Gina?
Everything's great so far.
Thanks
This
for
is
taking our
exactly what we
questions.
wanted to
Gina
hear.
Smirlik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today.
This
What
is an
did
important
75
question.
achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure.
Oh yeah, exactly.
So
for the Hawks.
if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I
Data
mentioned
dependent.
To Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and And that's what we did.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way.
All right, my day trade is over. I made my money and I'm
that
out.
That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I think I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
This is the most CNBC question I've ever heard.
It's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Dan.
All right, I'm going to pause it there for a little bit. Okay, so the conference is still going. They're having some questions right now, but I wanted to discuss my trade. I ended up buying the Qs. I got some calls on it when it was sitting down at the lower end. In fact, let me go ahead and pull the Qs up real quick so we can take a look at it. It's going to look pretty much exactly like the SPY because everything's trading in tandem right now. When this kind of stuff happens, you're going to see all the indexes. But here's what was going on. So during the very beginning of his speech and right beforehand, it was kind of hanging out down here in the low or the mid 270s or something like that, around 280. I ended up getting in, I think, during this candle right here. It was coming back up, and it had a little wick from the very bottom to about 277, 278. That's when I decided to get in some calls because I thought, all right, this looks like it's starting to get towards the bottom. It's not dropping heavily. If it drops a lot harder, then I would still think there would be a bounce, but there would be momentum to the downside, but there wasn't. All the downside moves were met with selling. So I thought, all right, if this isn't dropping right now at the most volatile point, it's probably a good place to get in. So I ended up getting some long calls naked on the QQQ, which is to me extremely risky. I used about half my cash actually to buy these calls, and I got them at just the right time because it started going up within like 5-10 minutes. It was already up about let's see, it was up to about like 280 or something like that, the Q. So I bought it around 278, it's up to 280. It went up in this candle right here when he's still talking. Basically, they realized everything is in line with what the market was thinking, and the Fed is not panicking, which is important. We wanted to know that. And then we got to this candle right here. There was a little bit of uncertainty. I thought, man, my contracts are up well over $200 a pop, which is nice. So it's like, well, $2 in option terms, but you always multiply that by 100. So my profit was up $200 per contract, and I was using half of my available cash to do this, which to me is very nerve-wracking. I don't like using that much money, but I was pretty confident in this trade, so I jumped in it and I took profits right here. I don't think it's necessarily done. I think this could go a little bit higher because we're still talking. People are still asking questions. They're trying their best to crash the market or pump the market with their questions and how they ask them. And of course, Powell is trying his best to not do those things. He's trying to keep everything as stable as possible. So just in case it ends up coming down or staying here, I wanted to take my gains. When you have gains, you have naked options, especially if you're doing a day trade. Even though I used a longer term option, like I didn't buy the ones ending this week. I'm not buying weeklies. That's way too risky for this. I ended up going farther out in time, so I still had a good amount of delta. I bought like 33 delta calls, so I didn't buy them right up at the line, which would have been extremely profitable. But I wanted to minimize my downside risk. And like, look at what's happening with the market right now. I'm actually glad that I took my gains when I did because those contracts. Actually, let me see what the contracts are at now. I gotta move my screen here so I can see it. Oh wow, the contracts are down $100 from where I sold them already. That is, yeah, see, this is exactly why I took profits because I mean, even though this could bounce, these things move so quickly, and you have to get them. The thing with options is they're going to be more valuable when they're moving in the direction of your call or put. Right. So if you have a call and it's moving up while the price is still going up, those calls are going to be worth more and more because people are getting FOMO and they're trying to buy in, and the sellers are saying, no, I got to bring the price up because it's still going up. So even though there's a set rate at which they theoretically should be, the action of buyers and sellers will move them farther. So as soon as that price stops, even and before it was even coming down, it was just kind of hanging there. The I mean, $50 drained right out of the calls within like 10 seconds. So I thought, all right, this is a big little down move. I'm up quite a bit. I want to take my profits while I can, even though I do think that it's probably going to go up a little bit more because it's probably just consolidating right now. I'm up well enough. I mean, $200 a pop or over $200 a pop per contract for me in like 20 minutes, 10 minutes is wonderful. I'm not going to push my luck. That's beautiful. That's one of my best day trades of all time, to be honest with you. I didn't say anything when I got into the contracts right away because I expected to get creamed on them. But I got them like right, I would say about 4 or 5 minutes into Powell's speech, maybe a little bit more than that, just because I wanted to make sure that I got in at a good point, because that's usually what happens. You think it's going to go down more with these Fed meetings. It's almost always the case that it feels like it's going to go down more, but that's when it bounces. Right when you think like, okay, this is where the thing's going to crack, that's where the bounce ends up happening. And if you look at this, if I back this up a little bit, you can see that it bounced off more towards the low of the day, right? So actually, the low of the last 2 days, because this is where it opened yesterday. So there's quite a few people that are expecting results from the Fed meeting that were getting in during this time. Not really super high volume. Actually, this looks like after hours. So this would have been yesterday. Yeah, that makes more sense. So this would have been yesterday right here. This is after hours. I was wondering why this volume looked like that, or why the price action looked like that, because it usually moves a lot more during the day, and this would have been like the middle of the night, around midnight or something. But yeah, it's coming down to about the highs of yesterday, which makes sense because that's where a lot of people were entering and exiting. And then overnight, people were anticipating good things because, as we were seeing from all these analysts and all these institutions, the expectation of the market was going up. So a higher rate increase when the expectation goes up is a good thing. That's what we had to think about. Before, if everything stayed the same as it was a month ago, then those increases would have seemed way more insane. Like if we had the expectations of last month right now, and the Fed came out and said, all right, 75 basis points, that would have been a tanking. The market would have dumped. But because the general consensus is that inflation is a huge problem, something needs to be done about it, that this higher increase is actually a really good thing. So that's why the market's liking it. Part of it is a squeeze, and part of it is the fact that the market likes that the Fed is picking things up a little bit. It also knows that there are risks, but because of the way the Fed is doing things, they're not worried about it. I mean, you could tell by the way Powell was talking that, yes, things are up a little bit higher, but it's not a problem. And some of that is him just trying to calm everybody down, because that's part of the job of the Fed, is to, help your psychology as well as your pocketbook. But at the same time, a lot of people were just uneasy about how this was going, and thought that maybe it was going to go a little more than it actually did. I did not. I expected pretty much exactly what you're seeing right now. And the fact that it's coming back down to this midpoint doesn't surprise me at all. That's the main reason why I got out, because I thought that with the last Fed meeting, we only had 1 day of higher prices. We have, let's see, how much time do we have left in the trading day? So we're 4 minutes away from power hour, which is the final hour of the day, where a lot of volume comes in and volatility picks up. And this would be the time to get in or out of some of those trades if this were under normal circumstances. But it's not. And so let's go back for the last 2 Fed rates, right? 2 Fed increases ago, we had like a week and a half of upward movement from a squeeze, right? People thought the first rate hike in years was going to be really bad, and it wasn't. It was a 25 basis point hike, and it just popped right up. So the next one, so that's like a week and a half's worth of time, right? You think about just green candles every single day. Then the next one was 1 green candle, and it came right back down the next day. It lasted till the end of the day and came down either after hours or in the next morning. But look at what's happening right now. We may not even get the rest of this day. See, this action doesn't look as much like consolidation to me. This looks worse. This looks like maybe we're going to stay here or test VWAP again. Yeah, this looks like we're going to test VWAP again coming up in a little bit. And if we do, that's an important part, because it could be that we crack below that and fall right now. I mean, if we were weakening every Fed meeting, the first one, we had enough fuel to squeeze for a week. The second one, we had enough fuel to squeeze for a day. Now it looks like we may not even have enough fuel to squeeze for an hour. I mean, Jerome Powell came out less than a half an hour ago, right? He came out, 28 minutes ago? And we're already coming back down to that median right here, right in the middle. This is exactly where we started when the rate announcement came out. It looks like it is bouncing a little bit. We'll have to see what happens. But right now, that's where we're at. Things are extremely volatile. Those contracts I bought are now down $100 from where I sold them, so I made a nice little gain right there. I don't know if this is going to hold. We'll have to see going into power hour. Let me bring up the Fed meeting one more time and just kind of see where we're at. There's not really much left. It's going to be a lot of the same questions, but it's good to see where he is. So I'm going to stop talking for a sec. We're going to see where he is, and then if it's interesting, we'll listen. If not, I'm going to wrap things up and get out of here for the day. But that was the goal. I just wanted to see what he said, maybe make a day trade, which I did. Made a good amount of money. It was probably my best day trade of all time. I'm super stoked about that. But we still have some problems. I mean, if the market goes down, we're going to have a serious drop. I'm a little bit worried right now about things dropping faster than I expected. Once it popped, I thought, okay, we might have a little bit more stability than I thought. But this 15-minute downtrend right here back to the mean is putting me off a little bit. Now, it's only 15 minutes. It could bounce. These consolidation periods could last, however long. You never really know. Oh, are we done here? Or are we going? Oh, we're going over for another question. All right, I'm going to pop this back on real quick, and then I'll come back and talk after.
The rate has to go up, and people lose their jobs in order to control inflation. Thank you.
So you're right.
Good question.
In the SEP, we have unemployment going up to 4. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that. And it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting
progress. I'm going to pause this. This is kind of an obvious question.
We didn't get that.
Here. All right, so that was very important when they were talking about the labor markets. That's been the fear of the mainstream, basically, is that the Fed is going to tighten so hard that they cut the labor market down and increase unemployment. When we just had a historic rise in unemployment after the pandemic and a near historic recovery after that, people don't want to cut that down. Right now, we just got things back to where they were. If you think about right before the pandemic, the unemployment rate was somewhere in the low threes, I believe, like mid to low threes, so about where it is right now. So we basically recapped most of those gains. And if the Fed tightens too hard, it's going to hurt a lot of these people. It's going to cut jobs because it's going to make it harder for people to get money. It's going to make it certain businesses are going to fail. Hiring has already slowed and stopped in some cases. So there's a lot of worry that they could cut the labor market down too much. Unfortunately, that kind of has to happen to control inflation, because part of what inflation is an acceleration of wage growth as well. I mean, people have more money to spend in the economy. It increases inflation. I mean, they're willing to pay more for things because they have the money to do so. So unfortunately, it is part of the cycle in dealing with inflation. You really have to, there is going to be some pain, and he's doing his best not to say that, hey, this is going to suck, but it's going to suck at some point, especially if they're talking about 3 to 3.5% being now the new mean, right? It was like 2, right? When we first started this whole thing in the beginning of the year, the end of the year goal was like 1.8, right? Which is kind of where it was about where we are right now. So we're, we've in half the time we've made it all pretty much all the way there. So now we want to double what we have right now. So they're talking about, oh, maybe a 50 next time. No, if we're going to get up to 3 to 3.5% by the end of the year, we need 50s and 75s, right? Because there's no meeting in August, and I think there's another skip on meeting later in the year. But we have like, I don't know, 4 or 5 meetings to go until the end of the year. So we're going to have to hit this pretty hard. And he's doing his best to not agitate the market too much. Like every journalist in there is giving it all they got to try to tank the markets. Like most of them want a drop. These people have been getting in positions for a market drop for a long time, and of course, what they also want viewers and stuff like that, which is kind of their main agenda. They're just trying to get people to watch. But if they can bring some bearish tones to this, then it looks better for them in the long run. I mean, their strategy, like CNBC, right? When I said this is a classic CNBC question, it's because that's what they do. They come out with the absolute worst thing they can think of to try to scare people. That's CNBC in a nutshell. We try to scare you. A lot of networks do stuff like that, but especially because CNBC is one of the more popular ones. So they're more likely to hit it with a much more bearish tone than everyone else. So basically what's going on right now, we've got a good plan in place right now. I actually like the plan that they have. If I'm taking a step back and not thinking about it from the plan of a trader, just thinking about it from, a citizen that is living in the society that this affects, I like their plan. I think when expectations went up a little bit, they moved up reasonably. They didn't overdo it because there were a bunch of analysts screaming for 100 basis point hikes, which I knew they weren't going to do. I mean, that would have been the new panic mode. If they came out and said 100 basis points, that would have been a good panic for the market. But they came out right in line with the 75, which is kind of what happened in the past week. So I'm glad that all of that I was able to pick up on all that, because sometimes there's such a mess it's hard to see. But it seemed like if you're looking at the forest through the trees, you can see that the median increase went up to 75, and that's a reasonable thing to do to stamp this down quickly. So if they hit it a little bit harder and they get it under control by the end of the year, then maybe it won't be so bad. But we have future projections that I'll talk about more of this on the stream this weekend for Sunday Night Finance, 3 o'clock Pacific and 6 o'clock Eastern. They have upped the projections for the next couple of years, because originally we were thinking, maybe this thing gets up to 1.5%, 2%, 2.5% by the end of the year. We stamp inflation down and then we bring rates down a little bit. That was kind of the original plan. Now they're talking about 3.5% by the end of the year. Next year, maybe 3.5 to 4%. And hopefully bringing inflation back down to that 2% goal after 2023. So we're talking about high interest rates for a little while. And it's sort of funny calling these high interest rates, because if you look historically, interest rates have been significantly higher than this. But the last really big bump, we went up to 275, I think, when it went down in 2018. And then when rates were up in 2007, it was like 5 or 6%. So we've kind of hit like if you look at each peak of interest rate hikes, they kind of halved each time. So we're in a place now where we're bucking the trend. My expectation for this was that we would hit like 1.75, and then we'd have to come back down because pressure would be too hard. And that was just basing it off of the lower highs of each time. But we're already on a course to surpass that. So that trend of 50% less each time doesn't seem to be holding up anymore. And that wasn't something I saw anywhere. That was just something I noticed and kind of thought like, okay, this is a possibility. Because my thought was if it's halving each time, it might be because the stress point of people paying their debt back hits a critical point when you get halfway. Right? Because people are taking on so much debt when interest rates are low that as they come back up, it's hard to cover all of that. And that's the point, actually. So the point of the Federal Reserve and inflation and everything like that, and the means to get it under control, is to cut this stuff down, is to make it difficult for people to keep using money like that in the economy. So unfortunately, they have to raise rates to cut down people's ability to inflate everything. So there's going to be pain for that. And there's going to be more pain than we thought at the beginning of the year. But this plan seems to be online with what the market appreciates. Like we've had a bit of a bounce after that drop up, but it's still kind of hanging out. So that tells me that the market is okay with what's going on. It's not super excited. The shorts didn't get squeezed too bad. I mean, they did on my little game there. Those two green bars right in the middle of the screen here are wonderful. I made that money right there. Oh, that was so good. But it's hanging out. Like we've had one. Let's see. Here's the drop. So 1, 2, 3, 4 candles just in this range right here, which would be about 20 minutes worth of time. Powell, it looks like is done now because the screen's frozen. Usually these things only last a half an hour or something like that once they actually start. So yeah, this will go. I'm gonna go ahead and dump this whole thing here. We can dump that. We can dump the Fed. Have our screen back. See what's going on. Okay, so I'm gonna wrap things up here. This was a really nice Fed meeting. It was exactly in line with what I was hoping. My day trade was on the Qs. I'll just look in here one more time to kind of give you a better idea. So as he was talking, I came in right here. I bought some 33 Delta calls in the QQQ, which I think would have been around the 290 strike. I got those for $500 a pop, and each one of them went up $200 right in this little 10-minute span right here. So I bought them right here, and I sold them right here. So I would say I was holding for about 15 minutes at the most. Right at the end, after the bounce on this. I didn't get it at this low part because you never really get the bottom, and I don't want to see that. What I wanted to see was a bounce. See, this little mess right here where it kept getting rejected going below this 278 price told me that there's a little bit of support in this area, and there's going to be some pull, right? So people talk about support as if it's like a ceiling, but the way I think about it is it's more like a magnet. Right? So on either side of this line, there's going to be a pull towards it. See, when they went above it, they still wanted to go back below. And when it went below, it still wanted to come back up. So this is kind of where everything was pulling to. Gravity was holding it at this section. So I thought, all right, if it goes down here and it bounces a little bit, and it doesn't seem like it's going to crack this lower area of support, then it might be an okay place to jump in on those calls. So I did. I had the order ready. I was watching the call. The call started to move up a little bit, and I thought, all right, here we go. Here's my chance. So I jumped in, and then it just skyrocketed right after that. That was the most perfect timing I could have asked for. Getting I would say a good 80% of this move right here is wonderful. Getting 80% of the total return you could have had is wonderful. I like 50%. My goal is if I have the ability to get $100 total and I can make 50 in a reasonable amount of time, I'm almost happier to make that 50 just because it gets me out sooner on something that's got a little bit more risk, like naked calls on the Qs during a Fed meeting. There's a lot of risk in that, but there's also a lot of potential, and that's why I went for it, because this is the standard pattern for the Fed right here. If there's one thing you take away from this entire meeting, is this is what usually happens during a Fed meeting. Now, you never know, conditions are always different, so I went into this extremely nervous, but it looked good, so I went for it. And like I said before, when the rates come out, there's usually a little bit of volatility, and then it sort of chills out for a bit. So as you can see right here, we had this big spike, drop, and then it hung out down here. It had a little bit of a pump because, that's just normally what happens. You can consider this basically a straight across move. It's a sideways move. So that's why I don't really mess with the numbers coming out themselves. So the numbers will come out at 11:30 Pacific, 2 o'clock Eastern, U.S., and then there'll be the consolidation for a little while, and then we've got Powell's speech. And right at the beginning, there's always that little dump for whatever reason, and then boom, we get the shot. Now, if this happened at the last meeting, this shot would have continued through the end of the day, but it's not right now. We've got 45 minutes left in the day, and it's hanging out. So I'll be interested to see how it closed, but I'm very happy with where I got out. Even if it shoots up at the end of the day, I still had a nice move. It was a quick gain. I took advantage of the option price volatility. Vega was extremely high during that, and that was what allowed me to profit so much, because let's see, nope, I can't go back. I don't have it there anymore. So yeah, I don't know where they are. I'm assuming they're still about 100 down, maybe 150 at this point, because it's hanging out, and options don't like to wait. Options will lose value even if the stock isn't moving very much, or even if it's moving in your direction but very slowly. Options will lose value because people that are trading them pull out. Buyers pull out, sellers stack up. You get a widening of the spread, which is terrible when you're trying to trade anything. Normally, when you're trading stocks or options or anything like that, you want to look at the spread, the bid and the ask, and see what you can get. So if you can get a nice tight spread, for example, the spread for the contract I bought was like 8 or 9 cents. So not a huge spread. That translates to $8 or $9 if you actually take the full value of the contract. So not a big deal. If I had gotten in and got right back out, I could have done it without too much pain. It wouldn't have been a big deal. But if I had been trying to trade something like Beyond Meat or whatever that was popping earlier, in fact, let's see if Beyond Meat's still doing whatever it was doing, because I think it was kind of funny that it was popping up all of a sudden. So BYD, look at that, they're way up. That would have been a nice little section to buy too. No news on it, right? So this just says Beyond Meat shares rise Wednesday to touch 1 week high, right? So okay, it went up. It went up to its weekly high. Big deal. But this is the kind of stock that when there's no news and it pops like this, I like it for a short. I'm gonna look at the contracts real quick actually and see what we can get going on this because I might want to do something. So let's see. What about 40? There's gonna be no volume in these. Yeah, there's no. This is why even though I want as close to 45 days as possible, just because that's when you get the best decrease in theta, or I should say increase in theta, but decrease in the price of the contract. Um, is 45 days and earlier. Sometimes if you get in at like 30 days, it's about the same as it would have been at 45 days and you can make the profit quicker. But I like having that time because if there is movement in your direction and you have some time, the delta will just cut it down enough to where you can get out. But you want volume, and this, even though it's closer to the amount of time I want, has no volume. I don't like these double-digit open interest numbers right here. There's 100 trades on this one, but I don't like it. So I'm not going to go for those July 22s. They are not cool. I'm going to take a look. There's going to be volume here in the quarterly contracts, right? See, there's thousands. This is more what I'm looking for, but I don't like the premium. What I want to do is sell calls on this thing. But look at these calls. They're disgusting. I mean, there's no profit here. So 40 to 45, risking $500, you could make $7. Ooh, because you'd be selling it to this bidder right here, and then you'd be buying it from this seller right below it to cover your $500 spread. So yeah, look at that, $8 right there. Ooh, it's not worth it. And what's the delta on that? So that's like is a 6 delta. Man, the 30 delta is the one that's right next to the strike. See, this is why I don't like this. These quarterlies, they're 500 or they're $5 wide spreads. There's no premium in it. It's too much risk. I don't like it. So what about this one? Okay, so this has a few hundred in each one. That's not too bad. And there's some premium here. It's 37 days, so it's a little bit more. Is there anything I could actually do that I'd feel confident in? No, see, look, there's $8 right there for your $1 wide strike. Still not worth it. I want to be making a third of the width of the strike. So if the strike is $1, that means it's $100 spread. So I want to make $30 on that. So we want to see the contracts. Like the difference between this contract and this contract has to be $30 in order for me to buy it, right? Or to sell it, I should say. And this is right next to the money. I'm not really getting that, right? 48 to 55, $7 difference for that. That's terrible. That is absolutely terrible. I would love to sell calls on this, but the premium is stupid. So I'm not going to do anything on that. I mean, unless I want to be risky and go in the money, which even going in the money isn't going to get you anything. Look at that. Let's see. What is it? This one's in the money, the 285 to 291. You can't. This contract costs more. Of course, there's a big spread right here. See, it's 248 to 291 for this contract, which basically that's a huge spread. That's what I'm saying. That's what, like $41 or 41 cents difference in the spread. Nah, I don't like that. It need to be a little tighter. So you could get this at a better price, but I don't want to sell this in the money contract right now, just in case things continue to go. So I'm gonna get out of that right now. What about buying? See, in buying puts, look at how expensive all these puts are. I could see it coming down here to like 20, 21, this area, but I'm not spending $200 on a stupid Beyond Meat put, especially if I want to buy a few of them, right? No, I don't like that at all. That's too much premium. That's what is terrible about options. When you have a good feeling about the direction of something, chances are everybody else in the market does too, and that's why you have that good feeling. So that it's priced in that way. So you can't make any money. If you had an edge, like you were so convinced that a stock was going down, but everyone else thought it was going up, then you have a chance to make money. You could sell calls on it, or you could buy puts on it, or you could short shares if you wanted to. And if you were to buy puts, the premium would be cheap because everyone thinks it's going up. And if you were to sell calls, the premium would be expensive, so you can make a good amount of money since everyone is buying them. They want to come in and up the demand for calls, so you can take advantage of that and sell some premium. That's what I like about options. Is it gives you a chance to make money in a few different ways, and you can do it with less capital, which is great. If you need to trade shares, sometimes you need, a minimum of like $50,000, $100,000, and $500,000, whatever it is you're trying to trade. But if you're trading options, you can do it with a few $1,000s, which is what I do. I take all my profits, put it in my long account, but I'm only trading with like $5,000 per trading account. I don't want to put too much into there in case I blow up. So I have to make sure that these trades I make are good, and I can't really do shit with $5,000. I could trade like Ford or something like that, but I don't really like to do that. I'd rather trade something, if I'm going to use shares, that I'm confident will go up. But with options, if you have about $5,000, if honestly, I would say like the bare minimum to trade options would be like $1,000. You could technically do it with less than that, but if you have $1,000, you have enough to make a decent amount of profit. But there's going to be a lot of risk, and there's a huge learning curve. So it's not just something I would say, oh, if you're having trouble, go and do it. It's something like if you're really interested in it and you think that's a good way to go, then study it heavily before you do it and paper trade them. Make sure you watch those option chains and see how they actually react to real events. But if you're going to use, $1,000, $2,000 and you're okay putting in the time, and you have the stomach for the risk, then that's a good way to go. I use that strategy to milk some money out of the market like I did today. Make those quick trades. I'm going to take a good chunk of that profit and I'm going to put it into my long account probably tomorrow. I'm going to wait for a drop to buy a little bit more, but I might use a chunk of it on my trading account to buy some crypto since it had that nice drop to 20K. I don't necessarily think it's done, but this is a wonderful price level. I've been waiting for this price for like a year and a half. It didn't seem like it was ever going to come back down here until we started having this little crypto winter, as everyone's calling it. To me, it's nothing. I love it. I don't even consider it that bad. I'm happy that it's down. That's the difference in psychology between now and when I first started. If I had been heavily invested in this and didn't see it as much of a trade, then I would be in so much pain right now. I probably would have sold. I probably would have given up on everything. But because it's actually down a lot and I'm not in very much of it, I'm happy. I'm absolutely happy about that. So I'm going to use some of those profits to get some crypto. I'm going to use the rest of them to get some more long shares, and then I'm going to leave a little bit in my trading account just to have some more cash because I've been using my cash. I had a couple of rough trades, and also I've been buying, so my cash pool has gone down quite a bit, even in my trading accounts. See, that's what's funny. Like even normally my trading accounts wouldn't have any long shares at all, but since things have been going down, I've been collecting them. One of my trading accounts has like 4 different stocks in it now, which I only had one, and I like having at least one long stock in each trading account just because it's number one, it's a hedge against your trading, and number two, it's a way to have some diversity of brokers like I was talking about on my stream. I have my long account in one broker, but then I have a couple of my positions in the trading account brokers too, just in case. So I'm trying to be prepared for all scenarios. Anyway, so today was a wonderful day. It went exactly like I expected. It really moved quickly, and I was able to get in at just the right times. Let's take a look and see how we're doing here. Let's go back to the SPY, actually. So the SPY are we getting back towards high day? Okay, yeah, we're getting back up there towards high day. So I kind of thought that maybe this would trend back up a little bit. It was a little odd that it was staying down here. The fact that it didn't crash below VWAP, though, is a good sign. So that's why I pay attention to VWAP, because it's telling me right now that the market is happy with what happened. That's basically what you can gain from VWAP. Like, people want to trade it and try to do all these, day trade patterns and time it and stuff like that. I don't worry about that. I basically I think of it as an indicator of market health. So we can see right now that it's been bouncing off of that VWAP level and it keeps going up. So that's a positive thing for the bulls, really. Is it going to hold this? I don't know. So we've got about 34 minutes till the end of day. I'm not going to stay for the rest of it. I'm actually getting out of here in a couple of minutes, but we'll see how this ends up playing out. It was a nice trade, getting in down here and getting out right up here on the Qs. Made a couple $100 a contract in 15 minutes. So that was really nice. All right, I'm going to get going here. It was a really interesting day. I'm going to be streaming again on Sunday Night Finance, 3 p.m. Pacific, 6 p.m. Eastern U.S. I watch the futures open. I go over the week's events, and then I go over a game plan for next week. I'm going to have a lot to say now because there's a lot of information to digest. And I'm still, up on cloud 9 from my trade going well, which is great because I was really hoping something would go well on stream. I didn't want to, come in and just lose a bunch of money all of a sudden. That's kind of what I was worried about. But 2 Fed meetings in a row, making a nice day trade and having this one be basically my best day trade ever. That's wonderful. So I'm going to get out of here. Thank you for tuning in. It was a very important meeting. It's been a strong week. It's been an interesting week, and I think it's going to continue to be interesting. So be safe. I'll see you this Sunday. Have a good week.